Hello and welcome to this session in which we will discuss the Flexible Spending Account, FSA. FSA is a special account that allows employees, notice you are an employee that work for a company, to put money away, and the important thing is before taxes. Before it gets taxed, you can put it away to do what? To pay to cover for certain qualified expenses. What are those expenses? You can pay two sorts of expenses with this, what we called pre-tax, money that hasn't been taxed yet. These expenses can be medical related or dependent care related. In this session, I will discuss both the medical as well as the dependent, starting with the medical related expenses. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. Who's eligible to participate in those FSAs? Most employees can participate in a healthcare FSA if offered by their employer. However, self-employed people and unemployed individuals are not eligible. So just make sure this could be an easy elimination. You have to be an employee. Who funds those accounts? Who funds the FSA? Well, it can be funded by the employee, so the employee can choose to do what? Put a part of their salary up to, this is just for informational purposes, in 2023, $3,050 into an FSA. This is done through an agreement with the employer to reduce the employee's salary by the chosen amount. So you could put up to $3,050. In some cases, you have employer contribution. If certain conditions are met, an employer can also make contribution to an employee's FSA. What are those contributions? Well, if the plan allows, the employer can contribute up to $500 for employees who don't contribute themselves, just basically put $500, which will be a great benefit. Or if the employee does contribute, the employer can match up to 100%, which is how much 100%? For 2023, $3,050 if they contribute 100%. The reason I'm mentioning the year and the numbers, just to kind of give you an idea, because it's easier to work with numbers. You might be looking at this recording in 24, 25, 26. You could have different limitation. So what are the tax benefits for those FSA? Well, the first thing, we already mentioned it. The money contributed is pre-tax. Pre-tax means it's contributed before it's included in your gross income. It's not taxed. It's taken from your salary before taxes are applied. We call it pre-tax. It's not taxed, which is good. And we're going to compute how much it will save you in taxes shortly. Now, bear in mind, it's not only federal taxes, also no employment or federal taxes. The contribution are exempt from both employment taxes like Social Security and Medicare, as well as federal taxes. So it's not only federal income tax. Also, you have Social Security and Medicare. And Social Security is 6.2%. Medicare is 1.45%. So together, they will come up to 7.65% plus whatever your federal rate happens to be. If it happens to be 20% for the sake of simplicity, they're saving you 27.65%. So the tax savings will be 27.65. And we would look at an example to show you how this works. But it's not only federal income tax, it's also Social Security and Medicare. It's excluded from that. And as long as the disbursement, as long as this money from the FSA is used to pay qualified expenses, the reimbursement are not taxed. So hold on a second. Are you telling me I put the money pre-tax, and when I take it out, it's tax-free? And the answer is yes. You get the best of both worlds. The money is put in pre-tax. If it's used for the right purpose, it's also tax-free. So in essence, an FSA is a financial tool that helps employees save money on taxes by using their pre-tax dollar to pay for specific expenses. What do you use them for? The use of funds for the medical, it has to be qualified medical expenses, such as unreimbursed medical cost, co-payment, prescription, over-the-counter medication. Now, bear in mind, contribution that are made to the plan and used for medical purposes, they cannot be deductible on Schedule A. You cannot double dip now, though. You cannot take pre-tax money, use it, it's tax-free to you. Let's assume you used it for medical expenses, then take this cost as a deduction on Schedule A. This is called like double dipping, actually like triple dipping. It's pre-tax. When you use it, it's tax-free. You're not paying taxes on it when you withdraw it. Then you cannot deduct it. It's just that's abusive. What happened to unused funds? The rules regarding the medical FSA is use it or lose it. They're not portable. This means if the employees need to spend, it means the employee need to spend the money in their FSA within the specified period, typically the year. However, if a money left in the account at the end of the year, employer can provide one of two options to their employees. So they give you a little bit of a leeway. The first leeway is you have 2.5 month grace period. So this option gives you additional time to do what? After year end, to spend this money on qualified expenses, qualified medical expenses. For example, obviously, if we're using calendar year, you have to spend the money by March 15th of the following year if anything is still not used. Remember how much is the maximum you can put? $3,050. Now, instead of the grace period, some employers may allow employees to carry over a portion of the unspent FSA funds to the next year plan. The maximum amount that can be carried is $610. Again, just to give you an idea, those numbers will change from year to year, but know that some employers would say, okay, for example, if you have $1,000, you're going to lose the difference between $1,000 and $610, but at least you did not lose the full $1,000. So just to give you an idea. Now, tax planning. What does that mean from a tax planning perspective? It's important for employees to plan their FSA contribution and spending carefully to maximize the benefit and minimize the risk of losing unused funds. For example, I'll give you an example as a personal example. The year that we have our child was born, we put more money in the FSA because we're going to have more medical visits by its nature. If we know for a particular year we expect to have more medical expenses, we put money in that account. So these provisions are designed to offer some flexibility to reduce the risks of forfeiture but do not eliminate it entirely. So just make sure you plan accordingly. Let's take a look at an example with numbers to show you the actual savings of this medical FSA. So let's assume we have Alex, gross wages $80,000, marginal tax rate is 25%. FICA tax rate is 7.65. Remember, part of it is Social Security, part of it is Medicare. Alex contributed $3,000 and Alex does not itemize. Calculate the net savings account using the FSA plan for Alex. Well, how much Alex is going to save? Well, if he put away $3,000, it means he reduced his taxable income by $3,000. Well, how much is the savings? It's the 3,000 times the tax savings. So you have income tax savings, which is calculated by multiplying the contribution by the marginal tax rate, 25%. So 3,000 times 25%. On the marginal tax rate, he saves $750. Then also he's going to save on the Social Security and Medicare, which is the FSA times the FICA rate, the FSA times contribution times 7.65 to $29.50. Simply put, Alex saved $979.50 on his taxes. So simply put, although he made $80,000, he was able to put immediately away $3,000. What's left to be taxable is $79. And by putting this $3,000 away, he saved $979.50, because if that $3,000 stayed, it will be subject to 25% marginal tax rate and the 7.65 Social Security and Medicare. Not a bad deal. So simply put, you could save approximately $1,000. So you put away $3,000, you use it for medical expenses, you save on your taxes $1,000. Not bad at all. Now let's by contributing, that's how much he saved. Let's take a look at the dependent care flexible spending account. Remember, we have a flexible spending account for medical reasons and one for dependent care. Here it's, as it suggests, it's set money aside, again, pre-tax earning to pay for eligible dependent care services. This type of account is useful when you need to pay for services for a qualified person, such as a child under 13, a spouse or a dependent who cannot care for themselves due to a physical or a mental limitation while the employee is at work. So the employee has to be at work. What do you need to know about the dependent care flexible account? The expenses eligible for coverage are the same. Those are for the child and dependent tax credit. So the same rules. So we learn about the child and dependent tax credit. The same people that qualify under those credit qualify to have the money used for them under the dependent care FSA. The primary difference lies in the tax treatment of these expenses. So simply put, if you have an FSA, you're going to get your tax savings immediately. Contribution to a dependent care FSA, you're going to get the tax deduction now because you're taking the money away and you're reducing your taxes. The child and dependent care credit, the tax credit, what you have to do, you have to wait till the end of the year, file your Form 1040, then claim the credit. So simply put, the FSA, you get your money up front. The tax credit, you have to wait until you file your tax return. Just to kind of give you an idea how it works, how much can you contribute to this FSA dependent care? In 2023, it's $5,000 per household. So you know it's $5,000 per household. This limit is adjusted for married couple who filed their taxes separately. In such cases, each spouse can contribute, but only up to $2,500. So each one separately. Now, in the context of divorced parents, the non-custodial parent is not eligible. Why? Because they're non-custodial. They're not taking care of that child. It's also important to note, and this is important, that the funds do not accrue interest. They don't accrue interest. And reimbursement from the plan are only available up to the current balance. What does that mean? It means you have to pay first. So you have to fund the account, then use the money in the account to pay for the child care. The medical, you don't have to. You can, it's available to you, but obviously you have to eventually make the payment. But the medical for the child care, you have to fund it first. Contribute, you have $300. Now you can pay that $300 to the child care services. Look at this multiple choice questions from FarhatLectures.com. How do contribution to an FSA affect the employee taxable income? So if you make a contribution to a flexible spending account, whether it's medical or for a dependent care, how does it affect your taxable income? It increases your taxable income. Is it? Where's the benefit? If it increases your taxable income, I would say I would eliminate this because FSA should give me a benefit. Increasing my taxable income is not a good thing, right? They have no effect on taxable income. Yes, they do have effect on taxable income. They decrease your taxable income. Is that a good thing? Yes, because I'm making this contribution. If I'm making $100,000 a year and I contributed $3,000 to my FSA account, what I did is what's left to be taxable is $97,000. In other words, I put away $3,000. Let's assume my tax rate is 30%. I saved on my taxes $900. They are subject to state but not federal taxes. No, they affect the federal taxes. They don't affect the state taxes. What should you do now? You want to go to Farhat Lectures and look at additional resources that's going to help you with your CPA exam preparation, your accounting courses, enrolled agent, whatever professional certification you are studying for. Invest in yourself. Good luck, and of course, stay safe.